Okay, so welcome. My name is Maria Weber. I'm one of the trainers at Financial Edge, and I am going to be talking to you today about M&A fundamentals. I'm going to M&A. Sorry, I thought I said valuation fundamentals, which is the thing that I did in my last Felix Live. So M&A fundamentals is what we are going to be talking about. I am going to be using some materials. I'm going to be using a simple M&A model. If you do have access to the chat, I'm just going to copy and paste the link to that in the chat. If you don't have access to the chat, you'll find that under topics in Felix. If you go to the Felix Live topics, and then you just have to scroll down to the bottom where we've got the upcoming sessions. So if you click on topics, Felix Live, you scroll quite a way down because we've got all the recordings at the top, and then you'll see here coming soon, M&A fundamentals, Felix Live. And if you click on that, you'll see in the bottom right-hand corner, there's two spreadsheets. M&A analysis workout empty, and then the answer file, which is M&A analysis workout full. Please do make this interactive. If you've got questions as we go, please do ask those questions. We are going to be keeping things quite basic, quite simple. To give you an idea of what we're going to be doing, we can't just launch into a model without having a bit of an overview of what we're trying to do and what the key concepts are. So I'm going to start with an overview, high level of key concepts. Then using the simple M&A model, we're going to demonstrate that. And then we're going to do a little bit of analysis. I'm definitely going to be doing EPS accretion or dilution because that is one important metric that people look at when analyzing an M&A deal. And then that will probably take most of the hour. If we've got time, though, we can have a quick high-level chat about some other performance measures. However, next week's Felix Live session, I'm doing that one again. I'm going to be focusing on M&A analysis. We're going to be looking at a bit of a more complex model, and we're going to be doing a lot more analysis on that. Okay, so plan for today, high-level, introduction, and then focusing on EPS accretion and dilution. If you have any questions, you can put them in the chat or you can put them in the Q&A pod, and I'll do my best to answer them as we go. Let's start off with high level. What are we talking about when we talk about M&A? We're talking about one company acquiring control of another company. So we're getting more than 50% of the shares. That's typically how we acquire control. We are also thinking here about strategic acquisitions. So one company buying another company. So Coca-Cola beverage company buying another beverages manufacturer. Or recently in the news, we saw Pepsi acquiring Poppi, like digestive drinks. So that's what we're thinking about. We're not looking at leveraged buyouts. Leveraged buyouts is where we use a lot of debt. Also, where there's private equity involved, it's a fund often buying the company. And so there we're not so much focused on synergies all the time. Okay, although you can have synergies, but let's not go down that road. So for now, strategic acquisition, one company acquiring control of another company. Very important to make the strategic decision in terms of which companies are potentially good targets for my business to buy. Once we've made that decision, we've then got two key things we have to assess. The first is, what am I going to pay? That is the valuation. The second decision is, how am I going to finance this? Where am I going to get my funding from? If we start with the valuation, valuation in an M&A context is like valuation, I would say, in any other context. When we think about things like equity value versus enterprise value, that's what we covered in the valuation fundamental sessions a few weeks back. You can watch the recordings on that if you're not clear on the difference between equity value and enterprise value. So conceptually, it's the same, but the difference when we are looking at strategic M&A is that we need to pay a premium. We need to pay a premium for acquiring control of the business. I'm not just buying a little minority stake, so I'm not doing a standalone traded valuation. I'm looking at acquiring control. So we pay a premium. Now, if this is a listed company that we are buying, we can't just pay whatever the share price it's currently trading at is. We need to pay a premium to that, and the price we pay is called the offer price per share. We've got to multiply that by the number of shares that we are buying. Like I said, more than 50%. Very often we buy all of the shares, and that gives us the acquisition equity value. It's then also very useful to know the enterprise value of this deal that we are doing. To work out the enterprise value from equity value, remember we add any other funding in the business, any other debt-like instruments, and we subtract cash and financial investments. So we take the equity value and we add on net debt. So that's same going over the bridge. The reason having the acquisition EV is so useful is we can then work out what's the acquisition multiple. We can compare that to other similar deals that have been done recently. We also use enterprise value very often to calculate the fees. So fees are often a percentage of the EV of the deal. Okay, so decision one is what is the valuation. Decision number two is, okay, now I know what I'm paying. How am I going to pay for this? The financing decision. And this is where we're going to do a uses and sources of funds table. Under the uses of funds, we've got the equity purchase price. That is what I'm paying. Now, we're assuming here that you're buying the shares of the company. Acquisitions can also be structured where you buy the assets and liabilities. So say, for example, you're buying just a division of a bigger company. You buy the assets and liabilities. Okay, we're not going to get into those complications now. We're buying the shares, so I need the price I'm going to pay to the target's shareholders. That's the funding that I need. I've got two main choices when it comes to raising money to pay for the acquisition. The first one is debt. So I take out a bank loan or I issue bonds. If I take out debt as the acquirer, I get cash, and the selling shareholders, the target shareholders, get cash in exchange for their shares. They give me their shares, I buy them, they get cash, and they walk away. The other thing that I could do is I could use equity to pay for this acquisition. Now, we know equity means shares, right? So I'm going to issue shares. Typically, what happens in an acquisition scenario, though, is instead of issuing those shares for cash and me then taking the cash and paying the sellers, I actually do what's known as a share-for-share exchange. And that is where the sellers of their shares get shares in the now enlarged business. That is called a share-for-share exchange. Now, when you do a share-for-share exchange, you get something called an exchange ratio, and I'll show you a practical example of this when we look at a deal announcement. But that exchange ratio, we're just working out, okay, for every one share the sellers are selling to me, how many new shares am I giving them in my company? And remember, my company is now going to own their company as well. So that's a share-for-share exchange. Okay, now, very often, if you have a big deal, you're going to use a mixture of the two. You're going to use some debt and you're going to use some equity. Any questions, guys? Please do ask. I had a good question coming out of the previous session. Any question's a good question, right? So please don't think about before you ask a question, is this good or bad? Any question is good. But a question from the previous session, someone said, okay, well, what determines how much debt, how much equity you use? Now, ideally, we'd want to use as much debt as we probably could because debt is cheaper than equity. Right? From a required return perspective of the capital providers, they require a lower return on the debt. We also get a tax deduction on the interest. So debt is cheaper than equity, but we are constrained by something called debt capacity. I can't just lever up super high because that then would have an impact on my credit rating. The more risky my business becomes, the lower the credit rating, the higher the cost of my financing becomes. And so one of the metrics we will consider is what happens to my debt. And that we're definitely going to have a look at next week. So impact on your credit rating. Okay, so ideally you want to try use as much debt as you can, but you're going to be constrained and then you have to use equity. Now, in reality, and we're going to see this in the model we're going to look at now, which we'll move to in a minute, the sources and uses of funds table is a little bit more complex. In addition to buying the shares, the equity purchase price that we've just seen, I need to buy the shareholders out. I also need to think about whether I need to refinance the debt of the target. Often, loan agreements will have what's called change of control clauses, which means that if the ownership of the company changes, that loan has to be repaid. So in an acquisition scenario, it often triggers those change of control clauses. So not only do I need to come up with enough money to buy out the shareholders and pay the equity purchase price, I also need money to repay the debt. And we say here net debt, because remember that's debt minus cash. So any cash in the target I could use to pay off the debt, and then I can come up with funds to repay the remainder. Okay, I might also want to repay the debt because maybe I can raise financing at a cheaper rate. I also need to pay transaction fees, lawyers, bankers, accountants. There could be some other adjustments I need to make. OWC, operating working capital, we'll talk about when we look at our model. And then there could be other things that I have to pay for, like if there's a pension deficit, and we'll talk about that in our model in a moment. So I need to come up with enough funding for this. We've already said 2 types of funding, equity or debt, that we could use. We also have to think about whether we, as the buyer, have a lot of cash lying around. We could use existing cash that we have. That's not earmarked for anything else. And then a revolving credit facility is another kind of debt, but that we would normally use for short-term fluctuating things, and we're going to see this in our model right now. So any questions, please ask. I'm just going to copy and paste the link to the materials one more time in the chat, just because if you have joined since I first posted it, you won't see that. If anyone's having a problem navigating there, please just let me know. But under Felix, topics, Felix Live, and then you will find the M&A session for today, and then at the bottom of that, we've got M&A analysis workout empty. The recording will be available. Normally it's posted, I think, Monday morning, UK time, round about there. So the recording will be made available. Great. And you'll find it in exactly the same place, Topics Felix Live. All the recordings are there. Perfect. Okay, guys, solution file is there. Let's have a look at what we've got. Loads of exercises. You can work through them all to consolidate your knowledge, but I'm going to work on the 4th tab here, M&A cash deal. So M&A cash deal, and it's cash deal 1. Cash deal 2's just got slightly different numbers as an opportunity to practice what we've seen. Before we launch in, let's just get a feel for what's going on here. Up at the top, we've got our acquisition assumptions and valuation, right? So remember we said decision number 1, we have to work out how much we need to pay for this target. So that's the top part. If we navigate down, we've got some other assumptions, like what are synergies, what's the tax rate, what's the financing cost. We've then got our sources and uses of funds table. So what we were just talking about, I need X amount of money. How am I going to raise that? Then we have got the analysis bit. Next week, I'm going to focus on just the analysis, but let's at least today do EPS accretion or dilution. EPS, earnings per share. I want to compare if the buyer does not do the acquisition, what would the earnings per share be? If we do the acquisition, what's the impact on earnings per share? And shareholders would like to see an increase in earnings per share. Not always possible, okay, but we can do a little bit more analysis on that next week. Starting up at the top, we have got the current share prices of the acquirer and the target. That share price of 4 of the target that we are buying is what's called the unaffected share price in the market at the moment. And we've estimated, and you can see this is an assumption, 25% premium is what we're going to have to pay to convince all those shareholders to sell and for us to gain control of the business. That is not set in stone. That's why it's an assumption, and that's one of the things that we'll flex and, do some sensitivity analysis around. Generally, between 20 and 40% premiums are paid. So we can work out what is the acquisition price per share. The unaffected price of 4 times 1 plus 25%, I have got an acquisition price of $5 per share. Now we've got a little bit of a complication on the right-hand side. Sure, sorry guys, I've just seen the web link for the Excel workings. If you don't have, sorry, I've just clicked on it by mistake. If you don't have access to the chat, let me just see if I can copy and paste this into the Q&A pod. I think if I type an answer to that. Okay, so just let me know, hopefully, if you've asked that in the Q&A pod, I've now got the link there as well. So just let me know if that's not working. We have got a little bit of a complication here now, and I don't want to get sidetracked by this because the purpose of today is M&A. It's not working out diluted number of shares. But on the right-hand side, we've got this dilution calculation. I'm going to do it really quickly for those of you that have seen it before. We can quickly do it. But if you haven't seen it before, you can just type the answer in. This, if you're interested, if you go to the Trading Comps playlist under Valuations in Felix, this is going to be videos 7 to 11, if I'm not mistaken. So if you want to look at this dilution calc, video 7 to 11 deals with this in Trading Comps. What we're going to do is we look and say, okay, at the moment in the company, there's 31 million shares outstanding, but we've got to look, are there any employee stock options that are outstanding that are going to be in the money? People are going to exercise them. And so actually, there's going to be more shares outstanding. This is my dilution calc. So very quickly, I know it's going to be too quick for those of you that don't know what this is, so just ignore me. Okay, and you can just type in the answer. I take the maximum of 0 and the difference between the acquisition price of 5, the strike price of 3. I divide that by the acquisition price of 5, and I multiply it by the number of options outstanding. And that gives me a dilution figure of 2. So like I've said, please don't panic if you didn't get that 2. It is around 2, so you could just type in 2. But what this effectively means is I'm going to have to buy out not just the 31 million shares that are currently outstanding, I'm also going to have to buy the 2 shares that are now going to be outstanding as a result of people exercising their stock options. Okay, so the number of shares I need to buy is 33 million shares. I can now work out the acquisition equity value. I'm just going to skip over this market cap line. We don't need it for now. So I am paying $5 per share. I'm going to buy 33 million shares. And so the acquisition equity value is 165. So just going back to our slides, if we think, where are we? What have we just done? We have just done this very first bit. We have worked out acquisition equity value. We're going to go over the EV bridge and work out what is the enterprise value. So let's do that. I'm told that in the target, the existing net debt is 40. Whether I have to refinance that or not, it still goes into my EV calc because I'm going to do a bit of analysis maybe. I'm going to say, what's the EV multiple? I need the EV to work out the fees. So that 40 goes into my bridge. And then this pension deficit adjustment, this is a debt-like item. Yes, it's not a loan like from a bank, but it is a financial debt obligation on the company. They've got a shortfall in their defined benefit pension scheme, which means they actually are on the hook for more pension payments than the assets that they have. So that's a debt obligation. So going over the bridge, we've got the equity value. I add to that any other financing items. So the debt and the pension deficit, and I would subtract cash, but I've already got net debt, and I would subtract any financial assets, which we don't have here. So we have got acquisition enterprise value of 225. Let's just take a minute to talk about this working capital adjustment. When this company is being bought, we are expecting it to have, at the time of closing, when we actually execute the transaction, to have more working capital than on average. On average, I mean, working capital fluctuates throughout the year. Think of something like inventory. If you are a manufacturer, a retailer, you would have more inventory in the build up to a holiday season. So my valuation is based on like an average inventory level. But if when I actually execute the deal, there's more inventory there, I'm going to have to pay for that as well. So think of it, it's like buying a car, but you buy the car and the gas tank is full. There's some extra value there, right? Extra thing I have to pay for. So that is the working capital adjustment. This is relevant for my uses of funds table. So let's have a look at that now. Please, guys, don't be shy to ask questions, either in the question and answer pod or in the chat if you have access. So our other assumptions we're going to skip over for now. Let's have a look at our sources and uses of funds. First things first, I definitely need money to buy out the shareholders. Okay, so let's go get my acquisition equity value. Acquisition equity value from row 12 is the 165 that I'm going to pay the shareholders to take them out. We are assuming here that we are going to be refinancing the net debt. That is often what happens. So in addition to the 165, I need another 40 to pay the banks back. What I also have to do is I have to top up the pension plan. The pension regulator, as part of the deal, there's lots of approvals and stuff that you have to get. They would say, okay, this plan is in deficit. You need to top that up. Okay, so we're putting in another 20. We need money for that. We then need money for this extra working capital. So that was that 10 adjustment that we just spoke about. And let's not forget the fees. That's where the bankers come in, the lawyers, the accountants. So the fees we are estimating, and you can see these are assumptions, estimating at 0.5% of acquisition enterprise value. So acquisition enterprise value, I've got in row 15. And so my total uses of funds is 236.1 million. So this ties in with the slide that we were looking at here, the more complicated, more realistic version, equity purchase price, plus I'm refinancing the debt, plus the transaction fees, plus I've got an OWC adjustment, and then I've got other claims on the business like that pension deficit that I'm going to have to top up. Let's now look at the right-hand side. Where am I going to come up with this money? You could approach this by working out the amount of debt you can take on. So you could approach this by saying, okay, what's the maximum debt to EBITDA ratio I think this company can have? What do we have at the moment? So how much debt can I take on? And then the balancing figure would be equity. Or you can say, okay, well, I'm going to use 30% equity financing and the remainder I'll finance with debt. We'll obviously then have to check that that's within your debt capacity. Now, an important thing to note here is this 30% equity financing. Remember, we said this is where the seller's shareholders get given shares in exchange for the shares that they're giving up. That 30% equity financing is only going to be applied to the equity acquisition value, because I'm buying shares from the shareholders and I'm issuing shares in my company in exchange. I'm not going to use that share for share exchange to pay back the banks, to pay back the debt, to pay the fees. So that 30% applies to the equity price that I'm paying. So let's work out the equity funding then. Equity funding is going to be 30% of that equity purchase price. So that's 49.5 million. Then I've got two types of debt here. I've got debt funding, so you can think of this as long-term bank loans or bonds. And then I've got an RCF. A revolving credit facility is typically used for shorter term things, things that fluctuate because you use it, you repay it, you use it, etc. So this RCF is going to be used for that working capital adjustment. So the revolving credit facility, we've got the working capital adjustment being financed by the RCF. And now we can work out the debt funding as being the remainder. I need to come up with a total of 236.1. I've already taken care of 49.5 of that. I'm going to give shares in exchange for that amount of value. And I've taken care of 10 of that. I'm going to have an RCF that covers that. So the amount of debt that I'm going to take out is going to be the 176.6. Right. Any questions? Please don't be shy. Before we go further with this, let's look at a real deal announcement. Okay, so I mentioned, for example, Pepsi buying that soda poppy, but the deal announcement, unfortunately, doesn't disclose a lot of information. So a deal that I was previously looking at that I really like it's from the end of 2023. I think it closed November 23. So not that old, year and a bit. J.M. Smucker Company. So J.M. Smucker, if we look at just what they do, for those of you that are not familiar with this, I think if you're in the US, you probably would be familiar with their products. J.M. Smucker, they do, here a nice summary. They manufacture and market branded food and beverages products. Okay, they've also got a bit of pet food, so branded food and beverages. If you look at these brands, okay, they've got some coffee, they've got their spreads, the peanut butter, the jams, there's pet food. This section over here, the Twinkies, that they acquired in an acquisition. So they bought Hostess Brands, and Hostess Brands was the maker of Twinkies. Now, Hostess Brands was a listed company, and J.M. Smucker is also a listed company. So if we look at their press releases, we've got here, if I just go to when this deal was announced, there we go, J.M. Smucker to acquire Hostess Brands. Let's look at some of the language that's used, some of the things that we are looking at. So first of all, there's lots of strategic reasons for them wanting to buy this, right? So the compelling strategic rationale, okay, we're not looking at that in detail now, but they are buying Hostess Brands for $34.25 per share. And they're financing this using a mixture of stock and cash. They tell us this represents a total enterprise value of $5.6 billion. And then there's 900 million of net debt. They give us the multiple that's implied by this enterprise value, looking at the EBITDA of Hostess Brands, 17.2. We can then, if we're doing, those of you that have heard of transaction comps, if now I'm advising another company in the similar space that would be advising on this kind of deal, I can look and say, okay, well, a recent deal, 17.2 times. That's what it was done at. Okay. Then we have got, I'll go back to the synergies in a moment. Let's see that 34.25, how it's being paid. We said a mixture of cash and shares. So each Hostess shareholder, Hostess brand shareholder, for selling their shares, they're going to get $30 of cash. And then they're going to be given Smucker shares to the value of $4.25. And looking at what Smucker's share price was when this was announced, we had a share for share exchange ratio of 0.3002 of Smucker shares for every one share that I'm selling. So that's my exchange ratio. How were they financing that cash portion? The cash portion funded through a combination of cash they had lying around, cash on hand, a bank term loan, and then bonds. Okay, so they're getting that cash from debt and some cash they had lying around. Sure, someone asked if I could share the link to this. I can do that. You can find it in Felix, but just for ease of reference, what I can do is, I think, if I click on that, you should be able to even see my highlights. So let me put that in the chat, and then I'll put this in the Q&A pod as well, just in case. Let's see if that's going to work. Great, that should work. Let me know if it doesn't. Okay. So this is very similar to what we're seeing here, right? We're using a mixture of cash and shares. And what we need to think about now, guys, anytime you're welcome, anytime we are issuing shares, we've got to think about, first of all, what's that going to do to the control in the business? So here, looking at ownership dilution. And second of all, we definitely need to know how many shares are being issued, because I need to work out earnings per share after the deal. I need to work out what the EPS is post-deal. So let's have a look at how many shares would need to be issued and then how many shares are going to be outstanding in total. So the new shares that I need to issue, I am paying 49.5 million in value using my shares. I'm JM Smucker. I'm paying Hostess Brands 49.5 million using my shares. So how many shares do I need to give to the Hostess Brands shareholders to make up a value of 49.5 million? Well, if the total value I need to give is 49.5 million, I'm just going to divide that by what my share price is now. So total value of 49.5. Each of my JM Smucker shares are worth $18. So that means I need to issue 2.8 million new shares. That's for the share portion. The remainder I'll give to them in cash. To work out the total number of shares that are now outstanding in the acquirer already has 15 million shares outstanding. Those aren't going anywhere. James Smucker, that's their shares, 15 million shares outstanding. In addition, they are now issuing 2.8 million new shares to the old Hostess Brands shareholders. So in total, there's going to be 17.8 million shares outstanding. Something we would just want to look at is what's the balance of existing shareholders in the acquirer versus the new shareholders we're letting in. So existing shareholders have 15 million shares out of a total of 17.8 million. So they own 84.5% of the now enlarged company. And the new shareholders coming in, they own the balance, which is 15.5%. So that is something we would want to keep an eye on, because if that goes below 50%, then actually the existing shareholders are losing control of the business. Okay, so we just keep an eye on those control percentages. We also need this pro forma shares outstanding for the next section that we're going to be doing, which is earnings per share accretion or dilution. Any questions, please ask. I'm going to skip over relative PEs, but that's quite an interesting analysis to do. I'll do that next week in our M&A analysis focus session. Let's end off today, because I'm keeping an eye on the time as always. Always for me flies by, but I think that's because I'm just talking so much. Maybe it doesn't go as quickly if you're listening. But with our EPS accretion or dilution, looks like a complicated calculation, but big picture. If I want to work out earnings per share, I need two things. I need total earnings, net income, and I need number of shares. I want to work out the pro forma earnings per share. Pro forma just means after the deal. What is this going to look like? To work out after the deal, pro forma earnings per share, I need to know what is net income going to look like after the deal. And I also need to know the pro forma shares outstanding. The good news is we've already got the pro forma shares outstanding. We just worked out over here, the buyer, I'm looking at this from the buyer's perspective. So say in this case, J.M. Smucker buying Hostess Brands. After the deal, once they've paid for everything, they're issuing 2.8 million more new shares. They're going to have 17.8 million shares outstanding in total. So that's the pro forma shares outstanding, the 17.8. So let's put that in, and I'm going to press F4 or function F4 to lock that, because I want to copy this to the right, because we're going to do the EPS for all the forecast years up to year 3. So to make sure that when I copy to the right, it doesn't move, I'm going to lock it. Okay, so we've already got the number of shares outstanding. So now we need the pro forma net income. Pro forma net income, this is consolidations, right? The group, after I buy the target, is going to consist of the buyer's net income as if they were standalone. So J.M. Smucker, standalone company, they're going to carry on. What would their net income be? I'm then going to add to that, okay, now what is the target's net income? If they remain as a standalone company, what's their forecast net income? I'm going to add the two of those together, because now we're going to be part of the same company effectively. So let's start by doing that. Acquirer's net income, if you go up to row 44, I've got for the actual, so historic, and then forecast year 1, year 2, year 3, earnings per share, and weighted average shares outstanding. So number of shares and earnings per share. So I can work out the total net income by saying earnings per share times the number of shares. That's going to give me total net income. I'm just going to copy that to the right. And I do exactly the same for the target. Their forecast earnings per share, if they remain as a standalone business, this is what's expected to happen. Their weighted average shares outstanding, let me multiply the two together to get the total net income for the target. So part 1 of working out the pro forma net income, I take the buyer's net income, and I take the target's net income. I'll copy this all to the right at the end. Okay, so that's like consolidation, one company plus another company. Now we've got this enlarged net income. But what I also have to consider is, what about the deal effects? These earnings forecasts that I've got here are for the two companies if they carry on operating separately. Now I've got to think about, okay, if I bring the two companies together, what's going to change? There's hopefully going to be synergies, right? Strategic acquisitions. I'm looking for synergies, cost savings, potentially revenue synergies. So synergies I want to bring in. And you can see here, be careful, we need to work after tax, because net income is your very bottom line of the income statement after tax. So synergies, we've got to make sure are after tax too. Now I've got this assumption for synergies. Up at the top here, we are assuming that synergies are going to be $5 million per year. So that $5 million I want to lock onto. So I'm pressing F4, but that's the synergies before tax. I want the after tax synergies, so I multiply by 1 minus the tax rate. Okay, the tax rate that we have got is a tax rate, I think it was 30%. I'm going to press F4 to lock onto that as well, because we're going to want to copy to the right. And so I have got after-tax synergies of 3.5 million per year. So 5 million is the synergies before tax. I've got to give 30% of my profits to the tax authority, so I'm left with 70% in my bottom line. A question from the previous session was, we including the synergies from the start, is that realistic? The answer is no, We're keeping things very simple for now. Next week, we've got a model, if I remember correctly, that builds up the synergies. Because think about it, cost savings, for example. You're not going to buy the company and then day one, the cost savings are immediately realized. It takes time for the synergies to be realized. And so what we would normally have is a build up to the full synergies. Going back to our JM Smucker announcement, the Smucker announcement, if I just hide my annotations there, they talk about annual run rate cost synergies, of 100 million. So run rate means fully achieved. And they say it's going to be achieved within the first 2 years. Okay, so maybe, I don't know, 50% in year one, and then the balance full run rate in year two. Okay, so we normally see a bit of a build up to synergies. So we've got synergies that we're now adding because these two standalone companies' earnings forecasts didn't include that. So let's add the synergies in. And then we've got to think about, okay, how are we financing this? Because if I'm using debt finance, I'm going to pay more interest than what has been built into my standalone forecasts. If I am repaying interest of the repaying debt in the target, I'm going to be saving interest. So if I have a look at my financing bit, I've got to build in that, okay, I'm going to have an RCF of 10. I'm going to have a long-term bank loan, say, of 176.6. This is new debt coming in to JM Smucker, right? The acquirer. And guys, I know I'm using JM Smucker as an example. These are hypothetical numbers, right? It's not that exact deal. It's just the deal announcement that I use just to avoid any confusion. So I'm bringing on new debt, the 176.6 and the 10. So more interest is going to be paid than what I've currently got in my forecasts. But I am repaying the existing debt in the target. So that is going to reduce the interest because I've built into my forecast for the target, the debt of 40, that's not going to be there anymore. So I'm going to net these two amounts off, and then I'm going to apply the interest rate, which we've got, which is 5%, and I need to take that after tax. Okay, because remember, we're working in net income. Net income is after tax. So let's do that, right? I'm going to open my brackets. I need to press F4, get dollar signs for everything because we're going to copy this to the right and we don't want it to move. So let's go pick up the revolving credit facility, F4 onto that. Plus, we're going to pick up the debt funding, F4, lock onto that. So that's increasing the debt in the business, but I'm going to subtract the existing debt of the target because that's going now. So I'm not going to be paying interest on that anymore. F4, lock onto that. And then we want the interest on this debt. So I multiply by the interest rate. And if we go to our assumption section, I've got in row 21, the 5% that I'm going to lock onto as well. And then don't forget, we want the interest after tax. I get a tax break on my interest expense. Tax is 30%, so that means effectively I only actually pay 70%. So my 30% tax rate, I'm going to F4 lock onto that as well. And that gives me 5.1. Now I've got to do one more thing here because this is interest expense, right? I've got new debt. Yes, I've repaid a little bit of debt, but on balance, I've got more new debt coming on. This is an interest expense, so I need to make this a negative. So I'm just going to multiply that by -1. And now I've got my pro forma net income after the deal. After the deal, the combined entity is going to have the acquirer's net income, the target's net income, and then because we're doing a deal, we hadn't yet built in any synergies in those two lines above. So I bring in the synergies. And then I've also got to look at the deal financing. If I'm using debt, I've got to look at what that's doing to my interest in my income statement. And I'm going to be paying 5.1 million more of interest every year. So that gives me 24.3 million as my pro forma net income. We've already worked out our pro forma shares outstanding. We've worked out that 17.8. So this is the second element of the financing impact. If I pay with equity, I issue more shares. So I've got to take that into account, which I have. And now my pro forma EPS is looking at the pro forma net income divided by the pro forma number of shares outstanding. And that gives me 137 for the combined entity. The reason I want to do this is so that I can say, right, if we do this transaction on these terms, this is what the earnings per share is expected to be after the deal. I'm going to compare that to if we don't do the deal. If we don't do the deal, we carry on as we were. What is our earnings per share expected to be? And that comes from row 45. And I want to see what's the difference. Is there accretion, which I hope to see, which is an increase in the earnings per share, or is there dilution, a decrease in the earnings per share? I take EPS after the deal, pro forma, divided by EPS before the deal, or if there's no deal, and I subtract 1 because I just want the percentage change on top of the 100%. And that gives me a 14% increase. Let's select everything. And if we've done all of our locking of cells correctly, if we copy this to the right, you should hopefully be seeing the same numbers as me. Don't worry if you're not. You've got the full answer file. Hopefully I've done everything correctly. And yep, I think that's looking good. If we copy to the right, we can see that we've got 14% and then 18.5%, 24% and 26%. So by this metric, and to be very clear, this is just one way we will analyze a deal, but so far, this is looking good, right? The buyer's shareholders will be better off from an earnings per share perspective after the deal versus if there is no deal. And for public companies, this is something that they very often disclose. Okay, so we see here, if we go back to our James Smucker Hostess Brands deal announcement, they talk about adjusted earnings per share expected to be accretive in the first fiscal year. Often, it takes a while to become accretive, if it becomes accretive, because of that synergy buildup, right? We don't get synergies straight away from day one. So what you might see in the first couple of years is a bit of dilution, and then you could see the accretion. Are there any questions on this before we've got 10 minutes or so? We should maybe just look at the debt ratings and calculate a debt multiple. We can think about that. Any questions before we do that? Okay, if not, let's use our last 10 minutes and talk about pro forma debt ratings. So a typical debt metric that we look at is debt to EBITDA. So it's a multiple. How many times higher than EBITDA is the debt? The higher it is, the more risky the company is because they have got more financial obligations. So if we look pre-deal, the acquirer had EBITDA of 156. They had debt of 300. So debt divided by EBITDA is 1.9 times. If we look at the target, what was their position looking like before the deal? They had that debt of 40 and they had EBITDA of 20. So EBITDA, earnings before interest, tax, depreciation, and amortization. So they were at 2 times. Let's look for the combined entity. So pro forma, remember pro forma meaning after the deal. We need to take the new debt into account, and we also need to look at the impact on the earnings as well, right? So if we first look at the EBITDA, do we agree? I'm going to have afterwards combined business, acquirers EBITDA, plus the target's EBITDA, plus, don't forget about our synergies. That's not built into the 156 and the 40. So to go find our synergies, we go up to assumptions, and that's 5. We don't take this after tax because remember, EBIT is before interest and taxes. So EBITDA before interest and taxes. So that's 181 pro forma. And we don't build in the interest either, right? Because it's before interest. So that's the pro forma. And then the pro forma debt, let's think from a consolidation perspective what's happening here. So I've got the acquirer's debt of 300 plus the target's debt of 40. But wait a minute, we said we are repaying the target's debt. So I'm going to go subtract that 40 that I'm repaying. So the 40 just cancels out. And then I've got to add in the revolving credit facility and the debt funding that I'm bringing on. And so the pro forma debt is 486.6. And now we can look and say, well, after the deal, what's the leverage expected to be? The debt is 486.6. The EBITDA is 181. And that gives me 2.7 times. We would need to do a little bit of analysis around that. We would need to look and say, well, at the moment, the acquirer, the buyer, because normally it's the buyer that takes on the debt to fund the deal. It's done at the buyer level. So they had 1.9 times. This is quite a big increase, right? They're going up almost by 1. So to 2.7 times. Would that lead to a drop in their credit rating? And if so, would it go below investment grade? Because if it goes below investment grade, which is BBB, you see quite a sharp increase in your borrowing costs because you're then much more risky if you sub-investment grade. So for this, you need to do a little bit of, credit analysis in terms of comparable companies. You would also need to engage with the rating agencies as the buyer if you are going to be pushing your leverage up a lot. Generally, for like an industrial public company, 3 times debt to EBITDA, roundabout there, is fine for investment grade. It obviously depends on the industry. If you're more cash generative, you can afford a higher debt to EBITDA, but the 2.7 times. But what you'll often see in announcements where debt is being used to fund the deal is something like this. So here we see an emphasis. If you look at the financial highlights up at the top, we see this emphasis on strong cash flow of the combined businesses to enable rapid deleveraging. And then at the bottom here, we see for the Hostess Brands James Smucker deal, pro forma total net debt estimated at the closing date will be 8.6 billion. Pro forma debt to EBITDA ratio will be approximately 4.4 times. That's pretty high. The company intends to maintain its balanced capital deployment model along with an investment grade credit rating. So the rating agencies will often say, okay, look, we know this is going to be temporarily higher, but they'll keep an eye on you actually deleveraging that. So it's not to say, oh, immediately now you're at 4.4 times, you're going to have a drop in credit rating. It would be assessed, and normally they give you, if you are deleveraging, they would take that into account. Okay, so guys, that is one of the metrics. To sum up, I think I'm going to leave this here because to get into the synergies, I don't think we have enough time for that. So let's just have a quick recap of what we have seen and what we've spoken about. And if there's any questions, then please do ask. So first things first, we said we need to make 2 decisions. One is the valuation decision, and the other one is the financing decision. But bigger than all of that for M&A is strategic rationale. If you look at that James Smucker press release, you'll see the strategic rationale for the deal. Okay, that is a very important part of it. Financially, though, yes, we've got the valuation and the financing decision. We do a sources and uses of funds table. Uses of funds, we got to pay the shareholders out, equity purchase price, and then we also likely going to have to refinance the debt, pay for transaction fees, maybe make OWC adjustments and other adjustments like pensions. Where do we get the money from? We might have cash on hand that we can use. James Smucker had some cash. We might then have to take out debt for the remainder if we're paying cash to the target shareholders, an RCF potentially for working capital, and then equity, that's your share for share exchange. And then from an analysis point of view, okay, we're not going to get into all of that. The one thing we looked at is EPS, accretion or dilution. We hope to see an increase in earnings per share as one of the metrics. And then in next week's session, we'll look at EPS again for a bit of a more complicated model. And then we'll look at credit ratings, synergies, and return on invested capital. Okay, so I'm going to leave things there. I will be here for the next few minutes if anyone has any questions. Otherwise, thank you very much for your attendance, and please do get in touch if you have any follow-on questions, and I hope to see you next week. So thanks very much and enjoy your weekends.